Get started. All right. Hello, everyone, and welcome to today's NCIA Industry Essentials webinar, Cannabis Cultivation Finance, What You're Missing for Better Profitability. I'm Brian Gilbert, Director of Engagement and Experience here at the National Cannabis Industry Association, and I'll be your host today. At NCIA, we're committed to empowering cannabis operators with the knowledge and tools they need to thrive in this complex and ever-evolving industry. Today's session, presented in partnership with our Cannabis Cultivation Committee, is designed specifically for cultivators looking to gain clarity around cost of production, inventory tracking, and cash flow strategies. We're thrilled to be joined by Velvet Kavanagh, a cannabis business strategist with decades of experience and founder of PhenoLogic, alongside Raymond Guns, CPA with Dope CFO Certified Advisors. Together, they'll walk us through some practical, actionable tools to help you strengthen your financial systems and move from survival mode to strategic growth. As I mentioned, a quick note about today's Q&A. We will be pausing between each section to answer your questions live. We've already received a number of excellent submissions through the registration process, so thank you to everyone who contributed to that in advance, but do keep those questions coming. Use the Q&A board that you'll find along the bottom toolbar within the Zoom platform throughout today's session to share your questions and help shape the conversation. So with that, I'll turn it right over to our esteemed moderator to kick things off, go through today's agenda, and dive right into the presentation alongside Raymond. So with that, Velvet, you can take it away from here. Oh, and you're muted, but go for it.
Thanks so much, Brian, and welcome to everybody. Thanks for being here. Just you showing up here is a demonstration of your commitment to financial success, so kudos to you for that. And to honor that time that you've set aside, I suggest that you mute your devices, close the door, make sure that you can focus. We're going to cover a lot of information today. And afterwards, we will have slides, some free resources, and a recording available for you to catch up with in case you missed anything. Quick little intro for myself. My name is Velvet Kavanagh. I work with craft cannabis company leaders to help you make smarter choices to increase your profits through my company, PhenoLogic. My background is 20 plus years as a company owner in low margin sectors, as well as extensive experience in the illicit sector. I help you to make sure that your money, your marketing, and your leadership are all aligned so that you can strengthen your company for lasting success. And I'll pass it over to Raymond to give an introduction for himself.
Awesome. Thank you so much, Velvet. Name is Raymond Guns. I'm a CPA with Dope CFO Certified Advisors. At this point in my career, I'm kind of a glorified salesperson, so I do business development for them. Speak with the cannabis business owners and operators, get a feel for what their pain points are, and if we can provide a solution to their pain points, bring them into our world and help them out. But that's my role with the company. Very traditional business background as a CPA turned financial professional for a large multinational. And so I don't have a cultivation background. I like to stay in my lane of accounting, finance, cost analysis. And so I think this will be a fun conversation. Appreciate it, Velvet.
Yes, it's nice when we can have fun talking about money, right? Raymond and I have had a lot of fun planning this, actually. A lot of people are talking about profits. Everybody wants to reach profitability, and it's essential to have a lasting company to be profitable. We know there's a lot of external pressures in the US. There's 280E in Canada. We have really steep excise tax. There's the cannabis tax if you want to deal with anybody who's outside of cannabis who likes to charge you extra. Steep financial commitment to participate, a lot of companies operating with a really high debt load, and yet there's still a lot that you can do to control your profits, even with all those external pressures. The reality is that 40% of new companies close in the first 3 years they've been operating. That's going to be higher in cannabis for the reasons that I just mentioned. And so it's critical that you have a strong financial foundation based and focused on what it is that you can control. That's what we're here to talk about today. I did interviews with many cultivators to find out what the most pressing financial issues for you are. 3 areas came up very often, and we're going to talk about those today. We want to demystify those and give you some tools so that you can work through them and increase your profitability. There's a lot of hurdles, like I mentioned, and part of the hurdles around finances in cannabis is that there's people who have the mindset of the money will come. it doesn't really matter when, or holding out for a higher price. Maybe you think that you're a grower, you're not a numbers person, or you're more focused on passion and you don't really care so much about the money. But the reality is, as a leader of your company, you need to focus on money. Money comes first. You're not going to run a company for very long if you don't focus on the money first. We're going to talk about all of that today and hopefully take some of the mystery and the emotions out of the numbers so that you can really see them as tools to help you run a more effective and lasting company. We've got 3 sections that we're going to talk about. We'll spend 10 minutes on each, and we'll have a little Q&A after each so that you can ask the questions while they're fresh in your mind, plus a final Q&A to get to any questions that you didn't get to ask or to ask questions that we didn't talk about. Please do use the Q&A to ask your questions. Ask any question about money that you want to ask. We're all here to learn, so please don't be shy about that. All right, Brian, let's hop right into our first segment. We're going to talk about cost of production, then we're going to talk about inventory management, then we'll talk about cash flow. So first we have cost of production. Some people call this cost of goods sold or COGS. Let's talk about what it means first. Raymond, how do you define cost of production?
It's kind of just, I was going to use the production in it, but it's kind of your cost to, and luckily we'll just put our hat on for the cannabis industry, but it's the cost to cultivate or grow your cannabis and take it from a seed to a finished gram or a finished pound or a finished sellable unit. And so those costs that happen from the beginning of the plant going in the ground or the seed going in the ground all the way through till you have a nice compliant packaged finished good that you can then sell, all of those costs are the cost of production. Another acronym or similar name is cost of manufacturing. But business tends to be on a timeline of, years, quarters, and months. And so just think of it as all the costs incurred from when the seed goes in the ground until it's ready for sale. And so, not to get too into the weeds, a lot of this will be in the next slide, but it's essentially all of your direct material, your direct labor, and your allocated overhead. That's the technical, description of what is your cost of production.
And so why does it matter to have an accurate cost of production?
The reason it matters to have a cost of production is because it locks in your gross margin per unit. And so every unit you sell has a cost associated with it. You just can't get away from it. And so knowing how much your actual cost of your unit is allows you to price each unit profitably. That's kind of the why it matters, is most people don't know their cost of production, so they don't know their cost of units. And so some people don't price their units correctly.
I think that happens a lot too. Can you get into some more of the details? Tell us, how do we figure out our cost of production?
So the cost of production, luckily, it's a calculation. There's zero guesswork involved in this. There is zero art involved in this. It is just a calculation. That's all it is. And so your cost of production is going to be the direct material. So for cannabis companies, and if you move to the next slide, I have a nice little list for you. So again, we only serve the cannabis industry at Dope CFO, so don't ask me for cost of production of a tomato grow, but from cultivation facilities, whether it's indoor or outdoor, the big cost buckets, and we kind of think of them as cost buckets, is cultivation labor. You need a team of people to grow the plant, to put it in the ground, grow it, trim the plant, prune the plant, top the plant, cut and hang the plant, dry the plant, cure the plant, trim the plant. Like this, all of this is usually done by humans. There's obviously a little bit of automation and machines and equipment we can use, but it's still labor intensive. The cannabis industry can't get away from it. Direct labor is the biggest cost. Next one is going to be utilities. This is more so for your indoor grows, but also even outdoor grows can be quite expensive. Electricity and water. When you're cultivating cannabis, it's an expensive plant to grow, depending on what your methods are. So utilities is part of overhead. Your rent or your mortgage of your farm or your facility is also part of overhead. So direct labor, allocated overhead, and then direct material. Anybody who's growing cannabis, it's a hands-on sport. We're dealing with living seeds, clones, plants. You need to have your beds made, which is going to require inputs into the soil to feed the plants, or however your irrigation system is. But there's going to be a lot of inputs into the grow over the time, from it goes into as a seed or a clone, grows up a little bit, gets to a mature plant, and the whole time it's acquiring costs. So those are kind of at a high level your costs of production, and some other costs will come in there, but those are your main buckets for every cultivation, whether it's indoor or outdoor.
And I've seen a lot of variation in people determining their cost per production. So can you break that down into why that matters?
The cost of production matters, again, because it's how you determine how to price the product. So you did your cost of production matters because it's the only, if you don't know your cost of production, you don't know your profits. That's where a lot of cannabis operators get upside down, is they don't know their actual cost of production. Thus, they don't know what price they should even sell their product at. And so the reason some farmers or cultivators will have different costs of production, because depending on your farm, you will have different costs of production. An indoor grow is going to have a wildly different cost of production compared to a greenhouse grow, which is also going to have a different cost of production compared to an outdoor grow. And so just knowing where you land there, indoor, greenhouse, outdoor, you're going to have a different cost of production. Obviously, outdoor is the cheapest, indoor is the most expensive cost of production. And then the
Mm-hmm.
second piece of that is most cannabis business owners, as of May 2025, they're not closing their books and actually allocating those indirect costs into inventory and COGS. And so because they don't actually allocate their rent into the cost of the pound, they don't track that cost. Because they don't actually allocate the electricity bill into their finished pound, or their water bill into their finished pound, they're missing a lot of the costs that should be in their, the cost of that produced pound, or that cost of that grown pound. So again, then they misprice it, and that's what hurts profit margins. So again, that's where you get the big discrepancy. Some cannabis business owners are doing it correctly, and they're starting to separate from the herd. They really know their costs of production. They close their books each month. They allocate all of the costs that need to be allocated, and they're starting to distance themselves from the ones that aren't. So
Mm.
realistically, that's just kind of, not to be biased, but the difference is some people are doing it right and some people are doing it wrong. So if you think your costs are out of whack and you're struggling to make a profit, you're probably doing it wrong.
Yeah, it's
And you'll
tough
be
when I
comparing
see
yourself to somebody
somebody
who's doing it right. And that's the
yeah.
discrepancy.
Yeah, and so when you see somebody who is selling or says that their cost per production, even though you're comparing indoor to another indoor, someone says that their cost of production is so much less, really in the long run, it's possible that they're eroding their own profit margins and they're not going to be successful. So short term, it seems like they're doing well, but long term, you're going to outclass them because they're not going to be able to last. Another piece that people wonder about is when you are producing flower, for example, and you have C grade, small buds that aren't going to be your premium seller, and then maybe you have your shake or your trim. How do you figure out what your cost of production is? How does that all filter out into those pieces?
So the way that it's done is because again, and this is where finance needs to work with operations, and this is where we can like really nerd out on this. But you hit the nail on the head, Velvet, right? Like, and this is where we're kind of getting into cash flow forecasting. But we put one plant in the ground, depending on 30 to 90 to 100 and some odd days later, we have a finished product, a finished grown pound. And so it's just, of that pound, though, some of the buds will be A buds, the tops, some are going to be Bs, and some are going to be Cs. And so the revenue that we can forecast off of that plant is going to be impacted by how much of the plant produces of A buds, B buds, and C buds. And so at a high level, you need to factor that into your cost of goods sold. How much did you sell that was A buds out of finished goods? How much B buds did you sell out of finished goods? How much C? So on and so forth. Without getting too technical, because it's hard to explain at a high level on this, but essentially you're going to take a percentage, this plant on average as 50% A buds, 30% B buds, 20% C buds. That 50, 30, 20% is going to be factored into the allocation. And yeah, appreciate Adam. We'll try to explain it at a high level, but yes, you need to factor in A, B, and C, because if you think all of your finished product is going to be A buds, you're going to have too high of a sales forecast. And as we know, yeah, you just smiled. It's like, I wish every run was all A buds, but no, it's going to be a mixture of A, B, C slash trim. And so getting those, what can we actually sell that for? And then factoring that into the sales forecast will ultimately factor into how much inventory will cost go into there. But yes, you do need to factor that in. That's where finance meets with operations, and we have that like actual F&O conversation. And that's also, again, at a high level, is most cultivation facilities don't have anybody on a they don't have anybody in finance. And so it's all operations people trying to figure out the accounting of the facility. It's all operations trying to figure out the inventory management, which is great. They're very hands-on, but you need that just somebody from finance who's unbiased and not in the weeds to try to kind of put it all together. And that's where, we don't grow weed. We don't sell weed. We have 8 hours a day just to manage the money. And so that's where I always kind of joke, like, finance just has more time in the day to deal with this stuff. But that's how I think through the ABC kind of factoring in, because it is important.
Yeah, I like how you broke that apart. So you're really talking about figuring out where your total cost of production is, and then understanding of your harvest, what percentage makes up the different categories of product that you're going to sell. And then you can correctly allocate your cost of production based on the percentage of the harvest.
And realistically, that's like at the end, it's actually much more important to understand your costs that are associated with production. Um, because again, that's on the front end of getting all of the costs into inventory. And that's where you don't have anybody in finance. So you have like operations people trying to figure out, like, is this depreciation expense inventoriable or is it not? I don't even know what a depreciation expense is. And so then it just doesn't end up getting an inventory. Again, inflating the actual, or deflating the cost of the pound, thus like hurting profits. And so that's why, again, it's actually getting all of your costs each month into a bucket, which just most business owners don't close their books, so they don't gather all of the costs into the bucket. They just kind of flutter about. And so it's like, no, you got to calculate all of your costs every 4 weeks, and then that's the start of getting the cost of production correctly.
That's a great overview. I'm going to just check in the chat and see if there's any other specific questions that have come up on this. Have you seen anything, Brian?
I haven't seen an exact worded question. Some comments and feedback. Some people posting some of their own internal tips for keeping track of cost of goods sold, which has been an interesting sort of back and forth. But no, I haven't seen any direct questions. So to the audience members, if you do have any specific questions that you wanted to post to the Q&A board specifically, recommended systems for cost of goods sold. I think that's from Adam. Raymond, if you wanted to maybe build on, like Quantum Leaf. Are there any recommended systems for tracking cost of goods sold that you have had good experience with, might just generally know about from across the industry? And then we do have a few questions that we got during the registration process that we can dive into as well, Velvet.
Sure. How about answer that question, Raymond, and then we'll hop on to inventory management.
Perfect.
Yeah, so like the best system I've seen for getting cost of goods sold correct is your month-end close systems. And so they're internal controls around the actual accounting of the business. Yes, we have a software that tracks the accounting. There's normally a purchasing software which will track many of the expenses. But again, sometimes there's a lot of cash expenses in the cannabis industry, and maybe those cash expenses didn't go through the software, through the bank account, nicely hitting the accounting software. So again, the best system is a really, really solid month-end close system, where at the end of every month, you close the book. So we're just starting week 1 of May. So I'll just use April as an example. We do this every month. So like the best system for COGS, Adam, is to close the books of April this week. So by this Friday, we're going to close all of the books, bring in all of the costs of direct material, all of the costs of direct labor, allocate all of the overhead that needs to be allocated to inventory. Boom. Now we have a real actual cost of production. And then from there, we can do our calculations and allocate. So there's not a software that I know of that does it really, really smoothly. And most cannabis companies are just pretty small. And so because the cannabis industry is made up of pretty small to medium-sized cannabis companies, I'm talking anything 50 million or below. Anything 50 million or below, best system is just a foundational finance workflow of closing the books each month, taking in all of the costs, like your actual costs and the accrued costs and the allocated overhead costs, and then moving that into inventory via cost accounting. And so that's kind of how we think through it.
Great. Thanks for clarifying that, Raymond. Let's move on to our next topic. And if you have other questions that come up, feel free to pop them in the Q&A. We'll get to them at the very end if we can, or else Raymond and I will answer you directly by email. Inventory management. What does that mean? Raymond.
Um, so inventory management, it's just all of the factors that go into carrying a optimal amount of inventory. As we've seen, unfortunately, in the cannabis industry, most cannabis operators default to make as much inventory as possible, cultivate as much inventory as my farm can physically cultivate, just more inventory. As we've seen in the cannabis industry, that doesn't always lead to profitable businesses. Actually, too much inventory leads to oversupply, supply much higher than demand, which then leads to price compression. So at a macroeconomics level, like that's inventory management. If you have too little inventory and you're stock out, every month, some month you have product, some months you don't have product, your customers are just going to associate you with not being consistent, and thus you're going to lose sales. So not enough inventory, you start to lose sales. Too much inventory, you have cash tied up in inventory, and you can't use that cash to do other things that you need to do in the business. So at a high level, that's what we're thinking through is, all right, what's the optimal amount of inventory?
And so it's thinking beyond, some people think, well, as long as I'm selling my stock, why does it matter? But you really help to clarify that it does matter. It doesn't matter if you're just selling your stock. You actually need to manage the inventory in a way that's effective for your company. Seems complicated though. So do you have some easy systems to help us manage our inventory?
Yeah, for sure. We're all about keep it simple in accounting and finance. Like you can get cute with some of these systems, but it's the simple ones that have been around for hundreds of years for a reason. That's the beauty of best business practices. They've been, they're timeless. So, kind of like at a high level, just basic systems, inventory cycle count is one of the most popular ones. So, depending on how many harvests per year your cultivation facility is having, you probably have built up some inventory from different batches, different harvests, different strains, yada yada yada. So, you're going to have many different SKUs in your inventory, and so every month, again, it's part of just the month end close process again. And I'm not trying to sell my wares. Like you can work with anybody, but just it's your life is easier if you close your books. So part of the inventory management, close your books, and then have somebody on the team who's part of the inventory management go and count a specific SKU of the inventory. Sometimes you'll do a full physical count where you will count 100% of the inventory. It's kind of sucks and it takes up a bunch of time and it usually makes people come in off hours. Nobody wants to do that. So the easiest simple system is just ongoing cycle counts each month. 1 month you count 10% of the inventory, the next month you count another 10%. You get through 10 months, you've counted 100% of the inventory. Depending on how many adjustments you have, you can start to see if you have a pretty dialed in inventory system. So that's kind of the most simple, basic one. And then a standard cost. You should get to some point, and again, we know our standard cost is going to have variables between the standard to the actual, but getting to a point where if you put 1,000 plants in the ground, you're going to have X amount of cost associated with growing those, and those 1,000 plants should use X amount of finished pounds or grams. So that's another one is get to a standard cost. And if you get through enough runs, you can average out your standard costs. If each room fits X amount of plants or, room, you can start to really dial in that standard cost. And so those would be the two biggest ones, like standard cycle counts where you're counting your actual finished goods inventory because that's the most valuable. And then also when you close your books, try to do a standard cost to actual cost analysis if you can. Um,
Yeah, and so you're talking about turnover as well. Brian, will you move to the next slide? And Ray, can you share some more about turnover so
Yeah,
that
so
people
this is
understand
for,
that?
and again, that's why I like cultivation. It's pretty straightforward. And so your cultivation inventory, if you're a cultivation company, what is your inventory? Your inventory is going to be made up of like the finished goods, again, packaged, compliant, ready to ship out the door, pounds or grams, as well as WIP, work in progress. So as it takes many weeks and months to cultivate your plants, a lot of the costs are going to go into WIP. So that's what makes up your inventory. But again, to simplify, again, let's keep things high level. Your inventory is going to be made up of how much pounds did you grow this year, how much pounds did you sell this year, or this time period, whether it's a month, a quarter, or a year. Your inventory is going to fluctuate. And so turning over your inventory is when you sold 100% of your inventory. The easiest way to understand inventory turnover is with a single harvest, standard outdoor grow. You put seeds in the spring, you harvest in the fall, you get one harvest. So say your harvest, you have 1,000 pounds finished goods and you sold all 1,000 pounds. That's considered a turnover. So if you have multiple harvests per year, which many indoor grows do, or greenhouses, they can get multiple harvests per year. It's how many times are we selling through 100% of our inventory in a year? Again, this is all subjective to your business model and where you're at, but just to give you like some guardrails so you can start to see where you fit into the standards for inventory turnover.
Mm-hmm.
And again, this is theory. So it's like if you're turning it over eight times per year, you might be understocked, in which case your harvest might be too small, you're coming out of stock often. And so it's like, all right, we're turning over inventory very quickly. That not always a bad thing, but it could be. And then if you're only turning over your inventory less than 4 times per year, that means you're sitting on product for too long. And as we know with flower, the the price that you could sell this flower for goes down very quickly over time via degradation, spoilage, all of that stuff. And so there's a sweet spot about 5 to 7 where we want to balance the quality of our product, because cannabis flower does go bad quickly. Our cash flows, like just how much cash do we have to work with? Obviously, if we had unlimited cash, we would just have the biggest grow and we would have a harvest coming down every single week, just this beautiful little clockwork. But we don't have endless cash. And we also don't want to run out of product. We're building a brand. Everybody knows when I come
Mm-hmm.
there and I want to get this strain from this grower, it's got to be there, or else I'm going to start going somewhere else. And so, again, that's why there's that sweet spot of like, you can't just have oodles of inventory sitting around everywhere. It goes bad. You can't always be worried about running out of inventory, or actually like running out. And so that's where there's that sweet spot of 5 to 7 inventory turns per year, meaning you sell out of all of your cannabis every 2 to 2.5 months. And again, a lot of this is dependent on your business model, but that kind of gives you an idea of, all right, if we're doing multiple harvests per year and stacking inventory, how quickly should we be able to turn this over, balancing quality and costs and sales?
I like how you brought up that point about making sure that you're really essentially talking about consistently being in stock at the store or wherever people are buying your product. Because when you're inconsistently in supply, in stock, then you're training your customers to buy from somebody else. So it is critical to make sure that you have what Raymond's talking about dialed.
Yeah, for sure, for sure. And then yeah, the next slide here, kind of just how I was saying, it's very cyclical, and it starts with forecasting how much weed can we actually sell. At least on the cultivation side, where we've seen people get upside down is they tend to overproduce. It's rare that a cannabis company goes out of business because they didn't have enough weed grown. It's more common for cannabis companies
Mm.
to go out of business sitting on a stockpile of inventory, and then they just weren't able to move it, and then cash flows got tight. They try to turn some into oil and enter a new market, but weren't really able to do that. And so keep that in mind of why demand forecasting is the starting point. I think all of the people, anybody who's grown cannabis over the last 10 years has seen the price slowly degrade over time. And it's purely because most facilities overproduce to like a very high margin, like a laughable amount of weed is grown that cannot be consumed. So as much as we can, let's try not to add to that macroeconomic issue in the cannabis industry. And then overall, your current cash flow issue for your business is what we've also seen is like the cannabis industry is not a standalone thing. The cannabis industry is made up of many, 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 many cannabis companies, and these many, many, many cannabis companies overproduce. And so again, that's why I'm starting with that for inventory management is try to grow enough to sell all of it. Um, in summary, we're in the weed selling business, not the weed storage business. That's where people get upside down. And I know there's new ways to store it and flash, fresh flash, frozen. It's like it don't go down that slope if you can avoid it. Unless it's part of your business model, then all the power to you. Inventory turnover ratio, like actually know how much you're going to sell, and then safety stock calculation. It's a little bit harder, obviously. Again, it's in a perfect world of business. If it was perfect, we would grow the perfect amount that we would be able to sell, keep some in safety stock, and then another harvest comes down. Then we sell the safety stock, and the new harvest comes in. That's the perfect flow, and so that's what we're striving towards, but we don't always
Mhm.
get there. And so again, that's why it's just better to be mindful of this every 4 weeks because it allows you to stay on top of your inventory every 4 weeks as opposed to looking at your inventory at the end of a harvest, which might be every 3 months to 5 months. And so that's where you really want to stay dialed in and just forecast, figure out how much what is our sell through, our velocity, and our turnover, safety stock. And a lot of these words seem like buzzwords, but again, like if you just start to research it a little bit, it will all make sense pretty quickly. And you guys do a lot of this intuitively. And so it's just putting a couple of, more frameworks around what you already do intuitively to manage your inventory.
Right. Brian, have we had any questions pop up in the chat specifically related to inventory? I see that there is one that's about cost, like yield loss, waste into cost per unit, and we could jump back to that when we do the final Q&A. Anything in particular about inventory showing up?
Yeah, I haven't seen any pop up into the chat room, but I do have one or two from the registration process that I could queue up that I think would tie in well with where we are in the conversation. So sort of, I'm never going to forget that we're not in the weed storage business. First off, that one literally made me laugh out loud, Raymond.
Man, that
But
was
I,
from Mary Ann Kershif with Alibi Cannabis in Oregon. Like she's kind of an OG in the industry, and she told me that like 2 years ago, and that just stuck with me.
yeah,
And so she's
yeah.
smarter than me, so you can rely on that one.
Yeah,
Yeah.
that's definitely one of those keep it in your back pocket kind of things. But yeah, I think this question is right on line with that. So sort of getting to that optimal turnover ratio period, I think, but more getting at specific product timelines. So we got a question that's sometimes I hold on to product trying to get a better price. How do I know when just to move it? Sounds like you've already addressed that a little bit, but any tips specifically for trying to figure out when that ratio, that sweet spot is?
Yeah, again, I always try to stay in my lane of like, I'm just the accounting and finance controls person. So the actual like operations might have a little bit more finesse to this. But the way that we think through this is when you close your books each month, part of one of the processes is about inventory. We got to calculate the inventory, figure out what it actually costs. But then we also are going to do an inventory analysis of aged inventory. And so luckily you guys are cultivators. So a lot of cultivation is wholesale. You have a big grow, you have big kind of orders that come in. And so you can look back at this harvest and know how many pounds or grams you still have to move from that harvest. And so the biggest thing is aging of your inventory. And so what we do is we have a standard calculation of every month we look at the inventory and any inventory. So we'll use April. We just closed April. Any inventory that is 90 days or older in the inventory, we're going to start writing off or at least write off a percentage of it to lower the inventory. That's just to, true up the value, but we also that's for us in finance, but then operations uses that calculation to be like, okay, if finance is already saying we're going to have to discount this 90-day-old inventory 50%, I should probably start moving it because I'm an operations person who runs this, facility and we're wholesaling cannabis pounds. So that's where that like finance and operations starts to work together is like we figure out what is really aged. And again, that's why it comes down to like you got to track your records every 4 weeks or else you won't really it won't be front of mind of like, oh shit, this harvest is coming up on 90 days. So if we don't move it by, 100 days, it plummets. And
Yeah.
so really you want to come up before it plummets. It's like, okay, we can
Hmm.
see this is getting a little old. What do we do? And that's kind of just how we think through it is every market is different. And even some markets have expiration dates where it's like they're even going to impose you having to pull it off the shelf and maybe do something else with it. And so keep all of these in mind, where as you start to approach these catalyst events where it's either the price is going to drop exponentially, you're going to be forced to do something, there's going to be a change in the market, which it does happen quickly,
Yeah.
try to move it. And so, and again, rule of thumb, shout out Marianne, is we're in the weeds selling business, not the weed storage. And I've seen more cannabis companies as of May 2025 go out of business holding inventory than go out of business without inventory,
Hmm.
because we can always buy inventory. Like that's kind of my whole thing. It's like, dude, there's so much weed being grown. We'll never run out of it as a cultivator at the wholesale level. And because we already know other cultivators, it's like, dude, just grow a little bit so we can sell it all. If we do get a big order, pull in some more and we'll fulfill the order. But like that's really the rub is like you don't need to produce a shit ton because everybody already is. It's dirt cheap. So it's
Hmm.
better to like drive sales. And then if you really actually run out and need them, pick up some more from your friends.
Hmm. Yeah, and a way to think about it as well is that your inventory is money. So if you
Yeah.
have inventory sitting there that you're not moving, if you're storing your weed, that's money. It's just a pile of money sitting there. And because it's not actually liquid money, you're losing a lot of opportunity because you don't have access to that money when the money is sitting there on product. So it's very important to keep that product moving. Don't just think that you need to hold out for a better price or the price that you think that you ought to get. It's important to get that product out the door so you can turn it into money.
Yeah.
So, talking about turning product into money, let's move on to our final topic, cash flow management, moving money in, moving money out. What is cash flow management, Raymond?
Just kind of as the name implies, is managing the cash requirements of the business. And again, I put on my finance hat. The way that we think through cash flow management, because we get it. This is where operations, like they see cash. They're like, okay, now we're talking our language. But for us, it's making sure we have cash in the treasury or cash in the bank to meet the obligations of the business. And so for us, we're cultivators. So we have a long cash conversion cycle where we need to start spending money in spring. We might not get paid until the fall or the winter. And so that's your cash flow management process is we need to make sure that we always need make sure we have cash in the bank to make payroll, make sure we have cash in the bank to purchase our raw materials and direct materials to grow and cultivate our product, have cash in the bank to pay all of our overheads, rents, utilities. So that's at a high level what cash management is.
Mm-hmm.
I think everybody who's been a business owner can just intuitively know about cash management, but that's how it is from the finance lens.
So, if I always have money coming in the door and I always have money going out the door, and I look at my bank account and I see that there's money in the bank, why does it matter if I track my cash flow as a separate thing?
Mm, because you might have money in the bank today and not money in the bank in the future. I think we've seen a lot of cannabis companies go through that. And so money in the bank doesn't matter so much as far as because that actually is cash flow, like cash physically flowed into your bank. And so that's actually like a one for one. Cash in the bank is pretty solid. But where people get upside down, Velvet, as they look at the sales number. And in cannabis, we know just because you sold 100 pounds to somebody with a 30-day net payment terms, you are not, you doesn't guarantee you're going to collect for that in 30 days. And so
Yeah.
your cash goes into your bank. That's actually pretty straightforward, but it's the business owners who just look at sales each week and they're like, man, we got to drive more sales. But sales does not equal cash, especially in
Yes. Say that again. Say that again.
sales does not
Ju-
equal cash. Um,
yeah.
and again, like the risk, because this is where like business owners, again, like operations doesn't really think of the risk. They just get upset when, a friend stiffs them. But from the finance perspective, bad debt, like somebody not paying for their product you gave them, it's about 2 to 3% outside of the cannabis industry or 1 to 3% in the cannabis industry, we've seen it as high as 10 to 30%. And so the cannabis industry, it just has a really laissez-faire approach to collecting cash for product sales, which I think is, it's not laughable. It's like it's hurting businesses and they're going out of,
Yeah.
literally going out of business. And so again, sales do not equal cash flows. So part of your cash flow management is how do we, which if you go to the next slide, that's kind of how I think through it, is like, how do we shorten the time from when I sell 100 pounds to when I collect cash for 100 pounds? Like, just to keep it as extremely simple as possible. And so again, the cannabis industry, there's only two ways to shorten the cash cycle: is upfront, encourage your customers to pay you on demand, where we've seen, again, it's the cannabis industry. We have to be creative. It's just the name of the game right now. And so we've seen people, again, this is why full circle, if you know your cost of production really, really good, you can do nice discounts if they pay cash on demand, or you can offer them a discount if they pay within 30 days. And realistically, cash in the hand today is much better than a 70% chance of cash in the future. And so you can start
Mm-hmm.
to upfront negotiate terms. Luckily for us in cultivation, we do a lot of B2B large wholesale. So you don't have a tremendous amount of buyers. So you can start to negotiate with a lot of these ones. And even if you are getting more and more and more customers you're selling to, that's the sales team's job. Negotiate terms on the front end. If I give you product, you pay me within 30 days. If you don't, that's okay, but I can't deliver product again until we clear up any past due invoices. Again, this
Mm-hmm.
is not new. It's not special to cannabis. It's just best business practice. Everybody does it in the cannabis industry. The ones that don't are starting to lose to the ones who are. And we've had enough years now in cannabis where the the ones who get it are getting it and the ones who don't are going out of business. And that's okay. You know, that's like it, you kind of feel bad at first, but after a number of years, it's like, well, you're just not cut out to be like the winning operating business owner. Because again, some of the stuff, it's not negotiable. Like it's not like some people do it and some people don't. It's like the losers don't, the winners do. And the
Mm-hmm.
next step is on the back end. So again, internal controls around collecting the cash. Every week, we meet, finance meets with the sales team. We review the AR aging. Hey, this person owes us X amount of money. They're past due. You got to give them a call. And then we meet the next week. And if that money hasn't come in, we give them another call. So, but most operations, like they're just never to that level. It's like the CEO is like also the salesperson. He's also like the head grower. And so it's, I get it. It's tough. That's why having basic internal controls, a 30-minute meeting once a week where you review AR aging, followed by 30 minutes of phone calls, 1 hour a week. Boom. Like you like just help the profitability of your business through this cash flow control.
Mm-hmm.
Again,
Yeah.
I
And
don't
thinking
know.
about that mindset piece too, around often people are hesitant or afraid to get on the phone and call somebody who owes them money, but that's how you're going to get paid, is by consistently showing up and reminding them that they need to pay you. Just take the emotion and the personal attachment out of that, because when they
Yeah.
don't pay you, you've given them the product for free, or they've stolen
Yeah.
it from you, depending
And
on
and they don't have
how you want to
cash.
look at it.
Yeah, because it's like then you don't have the value of the inventory, nor do you have the cash. So now you have nothing.
Mm-hmm.
And so
Yeah.
it's like I would way rather not give a client or a customer some more product that they haven't already paid for than to do it. And that's where that balancing act is of like, we're not in the weed storage business, but it's like you gotta do, you don't want to just operate with bad actors. We'll just kind of leave it at that. And but to
Mm-hmm.
Velvet's point, you can hear me like I'm very unemotional about this. And that's kind of like how we're trained as auditors, but don't be emotional about cash collections. And because the beauty is once you know your numbers and you treat it just like an SOP or an internal control, because we do the same thing. It's like, hey, the sales team calls their sales team. He's like, hey, billing's on my ass. When are you going to pay this? You know, we got to get this invoice in. So by using internal controls, you can blame the internal control, which takes the emotions out of it.
Yeah.
Or by using just best business practices, you can also just lean to that and be like, hey, this is how we always do it. What's up? But again, easier said than done, but just know that's why we have internal controls and best practices. So you can know you're not the crazy one. It's like, hey,
Yeah.
every business has payment terms. The customer is expected to follow the payment terms. If the customer doesn't, I'm probably not going to do business with them. And again, and that's why it comes full circle, where if you're running a product manufacturing facility and you need 100 pounds every week, the last thing you want is that order to not show up. And so you pay your
Yes.
bill when they come due, because I don't want my facility to slow down. So you can start to see where best practice operators start to work with best practice operators. And again, they're starting to separate. Whereas like old school, like, hey, I'll give it to you on the front. Maybe you'll pay me. Oh, they didn't pay me cash. They just gave me a different product back. They're starting to fall behind. Um, so that's why that's kind of like important of having that relationship and that mindset of like, oh yeah, I want to pay all of my vendors on time so I get paid on time so that I'm like front of the list every time. Again, easier said than done, but that's kind of how we think through it.
I like how you said that too, that people that are operating with best practices will work with and attract other people that are operating
Oh
with
yeah.
best practices.
Oh yeah.
And if you're a business person, you just realize this is how it is. You have your policy every week, you make your phone call to people who owe you money, and you know when to cut them off. And it's not an easy thing to do, but that's how you protect your company.
Yep. And like this cycle, just to kind of be mindful of everybody's time, it's, cash conversion cycle. We always, and it starts with accounts payable. So like we spend money first, unfortunately. So the money goes out, then we cultivate inventory, then we normally sell the inventory. And what I was just talking about, there's an accounts receivable where the cash sits with the customers until it finally comes back to us. And so managing that cycle and 100% Velvet, good operators end up working with good operators, and you'll start to see this when your order quantities go up, because as you start to work with larger operators, they won't even bring you on unless you can show that you have staying power. So it's, you need to have years of operating experience, be able to provide them numbers that show that have been organized and diligent in managing the books of your business, because everybody's done this. Like nobody wants to get a good supplier and then that supplier goes out of business. Like nobody wants to get a good, consistent customer and then the customer goes out of business. And so when you start to find like, oh, that guy's smart, he's going to be around for a couple of years, you start wanting to work with that person more. And if you work with somebody, you're like, ah, that dude's been around too long. He's always kind of shady and always been late on payments. It's like, you're just going to naturally stop working with them. And we can write the ship. So like, don't feel too bad no matter what camp you're in. You can always write the ship. And that's the beauty of writing the ship, is then you start to sail with people that are better operators, and they, like
Mhm.
they said, they want to pay on time, so they get paid on time.
So we're talking about cash flow management, and you've also mentioned about the long time from seed to sale to money in the bank. So how do you project cash flow over such a long sales cycle so that you don't overextend yourself?
There's a few different ways of forecasting sales, and so we've seen it a few different ways. And so you can do it either by, finished products, like how much finished product do we think we can cultivate with these many plants in the ground? Then you know how much your quantity is. That's one piece of the equation. So you have to calculate that, which is a calculation. You should be able to point to your head grower and be like, all right, Jim, you've done 5 runs in this facility. How much finished goods in products or pounds do you think you're going to get from this type of strain with these many plants with this type of grow environment? So that's the quantity piece. And then the price piece is the next piece that you need to calculate for your estimated forecast. And again, it's going to be from that harvest, how much is going to be A buds, how much is going to be B buds, and how much is going to be C buds. And again, all this stuff is market data. There's plenty of market data sources to get your benchmarks from, by state, by product, by SKU. So that's how you do it. Estimate how much quantity you're going to have for the harvest, cultivate what price point you're going to sell it at. But at a high level, that's just the sales piece of the cash flow forecast. The bottom piece is the most important, and that's your cost. Again, we can control our costs. I can't control if the market has a massive price compression because somebody brought in a bunch of stuff. I can't do that. But I can control my costs. And so,
Mhm.
how do you calculate and forecast your costs? Close the books for 3 months in a row and get all of your costs actually allocated into inventory. Take the average. And you'll know, like, as you start to get more trailing 3 months and you can look back at your costs and then take an average of your past costs of production and then forecast those average costs of production forward, you'll start to get a pretty dialed in sales forecast. And again, it's not a one off project. You do this every month. And then the beauty is like your variance of your estimated to actual will start out higher. And then over time, your variance from your estimated to actual gets very accurate. And again,
Mm.
the ones that do this over time and they forecast their cash flows each month, then they true up the calculation, they true up the forecast, they tighten their estimates, they get very, very accurate. And where we can see this in practice, just so everybody, using real world examples, Wall Street. There's Fortune 1000 companies, all publicly traded. And our job on Wall Street, I used to work there for a number of years, is we would forecast our numbers and then we would have to hit our numbers, hell or high water, because if we did not hit our numbers, the analysts of our stock would ding us and the stock would go down. And so we got very, very good of allocating this many sales and this much expenses every 30 days and then hitting the number. And so two takeaways. The government just required us to close the books each month. And so if you think it's hard to close a cannabis cultivation company with a handful of entities in a handful of states, try to close a company that's in a handful of countries with dozens of entities. It's hard, but it's a process and it's repeatable, and that's why we can do this for cannabis. So just know like it has to happen, but it gets very accurate over time. And you can see this with the Fortune 100 companies. Go check out the NASDAQ. They're always forecasting their numbers. And that's why you'll hear the analysts say something like Google missed its numbers in Q2 of this year. That hurt their stock price. Or, oh, they did better than expected and they hit their numbers. This is a strong quarter for Johnson Controls. It's the same thing in cannabis. So, like, just
Mm-hmm.
know that if you do this every month, you'll get more accurate. It's just people never get started. So, of course, they never get better.
Yeah. Yeah, the more you do it, the better you get at it.
Shocker.
So we're just about at the top of the hour, and so let's skip to the final Q&A. There is a question from Brandy that I'd like to get answered. And I think I know what the answer is from what I've learned from Raymond today. How is yield loss or waste factored into cost per unit calculations? I think that goes back to our first section that we talked about,
Mm.
cost of
At,
production.
yeah, at a high level, it's going to come out of the units of finished goods or the units of WIP, depending on where they are when the waste or spoilage happens. You're going to take them out of that, it's going to be wasted. So you're going to take down that number. You had a finished goods of 100 units, but then 10 pounds got moldy. So you had to take those 10 pounds away. It goes from 100 units down to 90. Then that is going to impact the calculation for your COGS. So that's where that gets caught. It's in the specific step of the calculation where you break down how many units are in WIP and how many units are in finished goods. And if usually we're selling the units, and that's why the units go down, but you'll also lose some units to spoilage, mold, etc. But that's where that gets caught. Again, it's all just a calculation, and you just got to figure out where these numbers get plugged into the calculation. Again, to Velvet's point, taking the emotions out of it.
And the more you do it, the better you get at it.
Yep.
We do have a few questions that have come into the chat room, Velvet. I know that we were a few minutes behind getting started, so I don't want to close the door on the room by any means. Do you want me to dive into a few of these questions that we've gotten into the chat room?
Yeah, that'd be great. Yeah.
Perfect.
Yeah. And if anybody has to jump off right now, that is 1 o'clock, then please do reach out to Raymond and I believe that our contacts are in the chat. We'd love to connect with you.
Yeah, perfect. So while we're I'll just go over to the contact info slide while we're diving into some of these questions so that anyone that might have to hop can take these for reference, and make sure to send out those LinkedIn connection requests after dropping from the call. So we got a great question. It was about halfway through here, so I think this was for section 2, but from M. Rolanoff. Can you explain the pros and cons of using a simple cash-based system or accruing the value based on cost incurred minus sales? And I can post that into the chat room. So if it's hard for me to follow that, so
I'd have to read it, but at a high level,
Yeah.
let me see this. Where is this question? But the way I think through accrual basis versus cash basis, I might miss the point of the question, but the way that I think through that, because at a high level, that is it, right? You can keep it on a simple cash basis. Many small businesses do, or you can keep your business on the accrual basis where we have accounts payable, accounts receivable, inventory, all that stuff. What we've seen is the accrual basis is gap compliant. And so if you start taking on other people's money, whether it's debt or equity, there's usually going to be requirements that your financial statements are on the accrual basis, just so the person who lent you the money can look at your financial statements and know very quickly that where your business is at. Because most businesses that take on other people's money are required to have financial statements that are consistent business to business. So that way, if the investor is investing in a retail store or investing in a cultivation business, he can look at the sales and the assets of the businesses and kind of see them as a one for one. So on the cash basis, it is easier, it's more basic, but it's harder to take out loans or raise capital or really understand the cost of your inventory, which will ultimately be the cost of your goods sold. So that's why I kind of prefer to do the accrual method and just accrue in
Mhm.
all the costs as opposed to the basic cash method, even though a lot of the companies are very small and it's like, come on, this is a really straightforward company. Like, what do you mean we have to do all these accruals and calculations? But just the nature of 280E and the cannabis industry and taking out debt covenants on loans, it's lends itself for accrual basis.
Mhm. And it's more standard across any kind of business is
Yeah.
accrual.
Gotcha. No, yeah, that definitely elaborated that answer for me a little bit. So thank you for diving into that, Raymond. We got another question, and honestly, I'm not sure if Herman posed this to the audience or to you all as well, but I think you all probably have some insights on here. Herman White asked, "Are there any insurance companies offering crop insurance?" I know that's a pretty generic question, but have you come across that, Raymond? And if so, does that strategy factor into any of the techniques that you've illuminated during the program?
So for crop insurance, my experience is if this was 5 years ago, definitely wasn't around. As of, 2025, I have heard cannabis insurance people starting to talk about it. And again, very specific situations where they can insure an indoor grow that's in this specific room with this specific lights, with this specific HVAC thing. As far as like crop insurance for an outdoor grow, we have that in like traditional ag. I don't know if I've seen that in cannabis yet, but I would say there, the cannabis insurance people, like there's some dude out there who has crop insurance. And if you ask, he's going to come running. So I would just Google it. There's got to be some person at this point that does crop insurance. And I know I've heard of one or two of them bring it up recently where I kind of rolled my eyes. I was like, nobody ever does crop insurance, but they were like, no, I swear we do it now. So I would say 5 years ago, no crop insurance. Now it's definitely worth looking into, but it's probably pretty expensive. You'll pay a premium.
Mm-hmm. Yeah, determining whether it's going to give you the value that you want and what kind of requirements they have around covering a crop failure might not meet your needs.
Yeah. No, that's always the takeaway from our risk management and insurance led sessions is you might be able to get insurance for something, but is this insurance actually worth anything? So yeah, definitely make sure that if you do secure insurance that you are doing it from a reputable provider and you've gone through the due diligence to ensure that it actually has some value on the flip side of it. Well, fantastic. I know that we've gone a few minutes over the allotted time. I see a few people trickling out of the room. So I want to activate our outro poll to get some quick immediate feedback from the audience members before you do drop. If anyone has any additional questions for our amazing all-star panelists, please do pop them here in the chat room onto the Q&A board, and we can use these as fodder for a post-broadcast blog. So if we don't have any additional live questions from the audience, I'll throw it back to Velvet. Did you want to leave us with a key takeaway from either yourself or Raymond before we close down today's session?
Yeah, well, really what we covered today are best business practices. And some of these business practices, particularly if you've come from the illicit sector, they're not practices that you necessarily would have followed. But in order to have a successful company in the legal sector, you do need to adopt best business practices around your finances. Just take the emotion out of it, look at them as numbers, and use the tools that you have at hand so that you can make the best decisions going forward.
So, last thoughts for me
Fantastic.
is just, yeah, you hit the nail on the head, Velvet. Like, if you are a legacy to legit operator, like, feel free to reach out. There are people willing to talk. Nobody really cares at this point. We've done it in Colorado, we've done it in Michigan. So,
Mm-hmm.
if this stuff's intimidating, just reach out to us. We're willing to help. And yeah, get you pointed in the right direction. But it was a pleasure. Hope you guys got value from this.
Yeah, thanks so much, everybody, showing up today.
Yeah, fantastic. Well, thank you, Velvet and Raymond, Velvet in particular, for really helping shape this conversation alongside Raymond, but also building off of your amazing cannabis cultivator survey that you helped facilitate with us last fall. So always like to see our educational programming building on previous content. So really excited to see where this content and this topic continues to expand from here. So please, audience members, on your way out, thank you for the immediate feedback there in the chat room. On your way out, make sure to give us some additional feedback. I know one of the questions in our outro poll is, what financial topic would you like for us to cover next? That will be really invaluable to give our cultivation committee the best understanding on the topics that are really going to be relevant for you and your cultivation practices. So please do stay on the lookout for an additional follow-up email that'll be sent out to everybody's inbox before the end of the week. It'll have access to an on-demand version of an on-demand recording of today's broadcast that you can share with your colleagues and coworkers. And if you are any of the attendees that didn't make today's live broadcast, just check your inbox and you'll make sure to get that first thing before we release it to the public, first thing next week. So thank you all again for joining us today for this episode of our Industry Essentials educational webinar. A big thank you once again to Velvet Kavanaugh and Raymond Guns for sharing such valuable insights. If any of you all found today's session helpful, we encourage you to get involved with NCIA, whether that's by joining as a member, attending future in-person or virtual events, or sharing this program with your network like I just mentioned. As I did touch on, a recording will be available soon. It'll come alongside a short survey. We'd love all of your feedback and suggestions for future topics. So until then, take care, stay connected, and we'll see you again next time. Thank you so much.
Bye, everyone.